Hi everyone, welcome back to our course number 6. Let us continue with the course. We should continue from module number 6, that is Max Payne and Pinterest. This is advanced expiry day analysis. Understanding Max Payne can give you a clear directional bias for Thursday Nifty expiry every single week. Let me show you exactly how. Max Payne is the strike price at which the total dollar value of all expiring options, both calls and puts, is minimized. In other words, it is the strike where option buyers collectively lose the maximum amount of money and option sellers collectively keep the most premium. Why does market gravitate towards Max Payne? Dealers, the banks, and institutions who have sold large volumes of options delta hedge their positions continuously. As price moves away from Max Payne, their hedging activity creates pressure that pushes price back towards it. It is not manipulation. It is the mechanical consequence of hedging extremely large derivative books. How to use Max Payne practically? Every Thursday morning, check Max Payne on Opstra.in. If Nifty is trading 150 or more points away from Max Payne with more than 3 hours to expiry, there is a gravitational pull towards Max Payne. The closer you are to 12 p.m. with a large gap, the more reliable this signal. Max Payne works most reliably when India VIX is below 15. The week has been range bound and no major news event is pending that day. It fails when a strong trend is underway or a surprise macro event hits. Track Max Payne for 8 weeks before trading. Build your own data. What percentage of time did Nifty close within 50 points of Max Payne? You will find it approximately 60 to 65% of expiries. That is a genuine statistical edge. 3 expiry day strategies for different experience levels. Strategy number 1. Max Payne trade. At 1:30 p.m. on Thursday, check where Nifty is versus Max Payne is. If gap is 150 or more points, take a position towards Max Payne. Stop 50 point against. Target Max Payne level. This is a mean reversion trade on the gravitational effect. Use Nifty futures on ATM options. Strategy number 2. OTM premium seller. With 2 hours to expiry. Sell one lot of Nifty OTM options 200 or more points away at minimal residual premium. 5 to 15 rupees. Collect the last of the time value. Stop if premium triples. 45 rupees for a 15 rupee sold option. Exit immediately. On a calm low VIX Thursday, this premium collection works consistently. Now, strategy number 3. Post-expiry setup. Nifty resets on Friday. New monthly contracts begin. Friday is a research and planning day for the following week, not a high conviction trading day for most strategies. Use it to analyze the week's OI patterns, identify next week's key levels, and reset mentally for a fresh cycle. Never try the expiry day strategies before 6 months of consistent FNO experience. Gamma is at its most dangerous. One unexpected move can turn a small profitable position into a catastrophic loss in minutes. Here is the systematic weekly framework I recommend for Nifty F&O traders. Monday, check max pain. Note highest call OI, resistance. Highest put OI, support. Set the weekly expected trading range. Look for Monday gap fade if SGX Nifty opened up or down significantly. Next, Tuesday, Fin Nifty expiry. Monitor for intraday volatility. Nifty OI is building for Thursday. Monday's OI additions give early directional clues. Wednesday, Bank Nifty expiry. Key day for BNF traders. For Nifty traders, observe direction of Nifty as a proxy for Thursday's setup. Thursday, Nifty expiry. 9:15 to 10 a.m. Establish direction. 12:30 to 1:30 p.m. Check max pain gap and consider max pain trade. Square off all positions by 3 p.m. Friday afternoon. Screenshot the full option chain before market close. This is your research data for the next week's OI baseline. Review the week's trades in your journal. One of the most dramatic phenomena in modern markets, module number 7, that is gamma squeeze mechanics. The phenomenon that turns 200-point Nifty moves into 500-point moves in hours. Once you understand the mechanics, you will never be surprised by these explosive moves again, and you will be positioned to profit from them. Let us begin. How a gamma squeeze happens. Gamma squeeze occurs when rapid price movement forces option sellers, specifically dealers, to continuously buy or sell the underlying to hedge their delta exposure. This hedging activity accelerates the price move in a self-reinforcing feedback loop. Let me walk through the mechanics step by step. Dealers have sold large call OI at the 23,000 strike. Nifty is at 22,700. These calls have delta of approximately 0.15. Dealers are short about 15% of the equivalent futures position. Gamma for these options is moderate. Now Nifty rallies to 22,900. Delta of the 23,000 calls is now 0.30. Dealers must buy more Nifty futures to hedge. They are now net short 30% equivalent. This buying from dealers pushes Nifty higher. Nifty reaches 22,950. Delta is now 0.50. Dealers must now buy more. This pushes Nifty to 23,000. Now, delta is 0.70. Dealers are frantically buying to hedge. The original 23,000 call wall has become the ignition point for a gamma squeeze. Momentum algorithms detect the unusual price acceleration in pile N. Retail FOMO follows. The move extends to 23,200 before exhaustion. When all nearby calls are fully hedged and no more forced buying occurs, then price reverses sharply as momentum players take profits simultaneously. Identifying squeeze setups and call or put walls. A gamma squeeze does not come out of nowhere. These preconditions make it likely. Preconditions are large call OI concentrated at strikes just above current price, The call wall. Market in a clear uptrend on the weekly chart. India VIX stable or falling. Low VIX means more OTM option selling, creating more potential for squeeze. Previous session showing long build-up in futures OI. Confirmation signals. Price breaks above the call wall strike with increasing volume. OI at the strike starts falling rapidly. Dealers are unwinding, forced to buy underlying. Price acceleration above the breakout. It does not pull back normally. Time and sales shows aggressive buying at the ask, sweeping multiple price levels. Call wall and put wall. The call wall is the strike with highest call OI, typically the most defended resistance level. The put wall is the strike with highest put OI, the strongest support floor. When price is between the put wall and call wall, dealers do not need to hedge aggressively and the markets drift. When price breaks through the call wall with volume, forced dealer buying creates a gamma squeeze upward. When price breaks through the put wall, forced dealer selling creates a gamma crush downward. Trading strategy. Do not fight the call wall on normal days. Wait for the confirmation breakout. Then buy aggressively and trail your stop. The most explosive Nifty moves 300 to 500 points in a single session. Almost always start with a call wall breach. Now, the methodology that has become globally popular among serious retail traders is smart money concepts. Let us learn about smart money concepts in module number 8. ICT methodology. Inner Circle Trader has become the most discussed trading methodology globally in the last 5 years. It is based on reading institutional order flow through specific market structure patterns. Let me give you the core framework. Market structure is the foundation of all SMC analysis. In an uptrend, higher highs and higher lows. In a downtrend, lower highs and lower lows. You know this from course 3. Change of character, that is CHOCH, is the first sign that the trend may be changing. In an uptrend, the first time price breaks below the most recent swing low. That is a CHOCH, which means change of character. Bears have broken the structure for the first time. It does not mean the uptrend is over, but it is an alert. Be cautious. Reduce long exposure. Break of structure. BOS is the confirmation of trend change. After a CHOCH, that is change of character in an uptrend, if price then rallies and makes a new swing high, the downtrend has started a BOS. 2 BOS in the new direction confirms the trend change. The sequence. CHOCH is your first alert, means change of character is your first alert. Break of structure is your confirmation. Trade entries only after break of structure is the new direction, not on the change of character alone. Premature entries on CHOCH are the most common SMC trading mistake. Order blocks. An order block is the price zone immediately before a strong, impulsive price move. It represents where institutions placed their large orders before driving the market. Bullish order block. The last bearish candle before a strong bullish move. This candle represents where institutions were accumulating long positions while retail was selling. When price returns to test this zone, institutional buyers have unfilled orders there. They reappear and push price back up. Bearish order blocks. The last bullish candle before a strong bearish move, where institutions were distributing and building short positions while retail was buying. Price returns to this zone, institutional sellers appear. The trading rule. Draw order blocks as rectangles. When price returns to test an order block, watch for a reversal. Confirmation, rejection candle at the OB zone plus volume surge. Enter in the direction of the original impulsive move. Stop beyond the order block. Target next order block or key level. Higher time frame order blocks are more powerful. A daily OB is more significant than a 15-minute OB. A weekly OB that price returns to test after months can produce trades with very large targets. These two concepts are the core entry triggers in SMC trading. Liquidity sweep. Institutions intentionally push price below obvious support levels to trigger retail stop losses. Collecting that liquidity, then immediately reverse upward. The false break was the entry point for institutional long positions at the best possible price. Your stop loss was their limit by order. How to trade a bullish liquidity sweep. Price breaks below an obvious swing low or support level immediately. Within 1 to 3 candles, reverse back above. This reversal candle is your signal. Enter long on the close of the reversal candle. Stop below the sweep low. Target the previous high before the sweep. This is one of the highest probability SMC setups. Fair value gap, FVG, occurs when price moves so rapidly that 3 candles have a gap between them. The high of candle 1 is below the low of candle 3, leaving an untraded gap. This represents an imbalance. Institutional orders were placed so aggressively that no two-sided auction occurred. FVGs acts as magnets. Price will return to fill the gap because institutions left unfilled orders there. When price returns to the FVG, watch for a reaction. Enter in the direction of the original impulsive move on a rejection candle from the FVG. Stop beyond the FVG. Target next significant level. Most powerful setup combination, liquidity sweep of a key level plus immediate reversal that creates a FVG. Enter on the FVG fill. This triple layer setup has exceptional probability. Supply and demand zones. Supply and demand zones are the SMC interpretation of support and resistance, but identified differently. Instead of looking for multiple touches, you look for the origin of an impulsive move. Demand zone. The price area from which a strong bullish move originated. The candles immediately before the upward explosion, typically small, consolidated candles. This is where institutional buy orders were placed. When price returns here, those orders are still waiting, except a bounce. Supply zone, the origin area of a strong bearish move. The origin area of a strong bearish move. Small consolidation candles before the drop. Institutional sell orders placed there. Where price returns, sellers reappear. The strength of a zone is measured by how explosive the initial move away from it was. A 3% daily move originating from a zone means heavy institutional conviction. A zone that has only been tested once. Fresh zone is more powerful than one that has been tested multiple times. I will tell you the best setup. Fresh demand zone on daily chart aligns with a higher time frame order block. Price returns with volume dry up and a bullish candle at the zone. All three together equals a high conviction institutional long entry. The 100-year-old methodology that still defines how smart money accumulates and distributes. In module number 9, that is the Wyckoff method. It was developed by Richard Wyckoff in the 1910 for the US stock market. The accumulation and distribution patterns he described appear with an almost identical structure in today's Nifty and Bank Nifty charts because human psychology has not changed in 100 years. The Wyckoff accumulation schematic has 5 phases. Phase A, preliminary support and selling climax. After a prolonged downtrend, the first signs of institutional absorption appear. Heavy volume on down day starts declining. A selling climax, a dramatic high volume drop, marks the capitulation of the last sellers. Then an automatic rally as buyers overwhelm the exhausted sellers. Phase B, building the cause. Price trades in a range for weeks or months. This appears boring, a sideways channel. But inside this range, institutions are quietly accumulating. You see rising OI in futures, but price not moving much. Volume is steady. Occasional shakeouts below the range bottom. False breakdowns that immediately recover. Phase C, the spring. The most important and most profitable. Wyckoff signal. Price breaks below the bottom of the accumulation range, triggering all retail stop losses, then reverses upwards rapidly. This false breakdown, the spring, is the institution's final shakeout to collect cheap supply before driving price higher. Volume on the spring is relatively low, confirming that selling pressure is exhausted. Sellers could not push price further. Phase D, breakout. Price breaks above the top of the accumulation range with increasing volume. This is the first confirmation that the Wyckoff accumulation is complete. The markup phase begins. Phase E, markup. The new uptrend. Institutions have finished accumulating. Price trends higher. Every pullback in phase E is a buying opportunity. the highest probability Wyckoff trade. By the spring, price dips below the range low, reverses immediately with a strong bullish candle, and volume on spring is lower than the volume at the range low established in phase A. That volume signature is your confirmation. Stop below the spring low. Target top the accumulation range initially, then much higher as phase D and E unfold. Wyckoff laws. 3 Wyckoff laws that govern all markets. Law number 1. Supply and demand. Price rises when demand exceeds supply, falls when supply exceeds demand. This is the foundation. Always ask, based on volume and price behavior, is there more urgency to buy or sell right now? Law number 2. Cause and effect. The length of the accumulation range determines the extent of the subsequent rally. A 3-month tight accumulation range produces a minimum 3-month rally. Count the TPO or range points to estimate the target. This is Wyckoff point and figure target method. Law number 3 is effort versus result. Volume is the effort. Price move is the result. When high effort, high volume produces little result, small price move, something is absorbing the effect. If high volume produces no rally, distribution is happening. If high volume on down days produces no further decline, accumulation is happening. Wyckoff distribution is the mirror of accumulation. Upthrust after distribution, that is UTAD, is the mirror of the spring. Price briefly spikes above the distribution range, triggering retail breakout buys, then reverses downwards sharply. Institutions were dumping into those retail buyers. UTAD on high volume is the tell. Real breakouts happens on high volume and price does not immediately reverse. False ones, UTADs, reverse within 1 to 2 candles. I would request to all the viewers, please subscribe to stay updated with latest educational videos and visit fintamin.in for more insightful knowledge on stock markets and financial planning. Do visit www.fintamin.in for your free financial health report. Thank you and see you in the next video.